the one who take a very good setup and it just end up hitting stop loss before actually hitting a target most of the time. So hi everyone, my name is Harsh and I've been trading for the last 4 years. In this video I'm going to talk about the 4 key things that you need to understand to eliminate your low probability setups. Okay, so the very first thing that you need to know is higher time frame. When your higher time frame is unclear, which basically means you are entering based on just one time frame and whether it's support resistance or anything and hitting stop loss. For example, here you can see on the screen you are having a nice setup on H1, but if you just switch to the higher time frame like daily here, you can see there is nothing to be seen that is giving you a trade. So examples like these are very simple, that is higher time frame is basically not clear. So how do we solve it? It's very simple. All you have to do is understand the time frame alignment. So basically there is two time frame, either it's a higher time frame or it's a lower time frame. So for example an H4 and 15. So what you wanted to see on these time frame, the very first thing that you wanted to see on these time frame starting is dealing ranges and higher time frame PD array, which basically means any kind of premium discount array. For example, it could be any pair, order block, or something there that you need to trade off. So your higher time frame POI comes from that time frame, which is your basically HTF. Second thing you need to know is the liquidity, whether it's a higher time frame external or internal liquidity. Third, which you can look for, is SMT or stop on, that it depends upon your style. And fourth thing is you decide, are you going to looking for buy or sell? So you just decide that. Example, here you can see you have a higher time frame narrative on the daily chart on euro, where you can see you have this daily fair value gap forming here. If you also look at the premium and discount zone, you can see we are in a discounted price, and you can also spot some divergences with the another pair, and everything that you need to do to confirm the buy should be done on the higher time frame. And now once you look on the lower time frame, all you have to do is wait for the confirmation or wait for the entry. For example, that was a daily time frame, so we can use 1 hour to take our trade. And here we can see we have this sweep of this low, and then you can maybe just wait for this fair value gap to form for a displacement or whatever type of entry model you have. You can simply trade that on your lower time frame. For example, me, I just wanted to see a sweep with displacement. I get that, and I'm gonna trade this for a 1:2, for example, let's say, and then just let it play the way it does, and that's just how it helps hit your final TP. So that is how you do it. So every time you need to understand that the higher time frame is the foundation of every trade that you take. If you are trading without the higher time frame perspective, you are basically gambling. Okay, always see if it is ranging, is it directionless, or is it contradicting to your lower time frame plan. Or if you're not doing it, you're basically entering blind, and that's not what trading is. And always ask yourself, when you look at the higher time frame, is the higher time frame bullish, is it bearish, or is it stuck? And understand, if it is stuck, you should be too. Whenever you see higher time frame, always look for the POIs to trade on, divergence and liquidity to target, and make your bias. And then you go on the lower time frame, and then you look for setup. If you are scalping, look for setup on the specific kill zones time and all. Alright, so that's the thing we need to talk about. The third thing is having no liquidity in the market. Okay, so let's try to understand this in very simple terms. So whenever you are taking a trade or entering a position, you always have to wait for the liquidity hunt or liquidity sweep in the market, which basically means people getting stopped out. Okay, because if you don't enter after people getting stopped out, you are the one who are going to get stopped out. Okay, and that's the thing. And how do we identify it? So a liquidity sweep is a sweep of a certain high or low on the chart, when especially on your entry time frame. Okay, so that is the first thing. Second is liquidity to target. So there should be two things always. There should be liquidity when you enter, and there should be liquidity to target whenever you are looking for a trade. So here in this case, you can see that once you entered or planned a long trade after taking stop loss or hitting stop loss or others people, and you enter a long trade after the sweep, you should have a clear drawn liquidity, which is a external high or external low to target for your liquidity. Okay, and that's where the price should head from. So for this, a very good concept you should know is IRL and ERL. So the market moved from fair value gaps to external highs or lows, or from external highs or lows to fair value gap, which is your internal range liquidity. Okay, so let's go over the chart here. For example, here you can see on the chart that we had this H4 fair value gap on this, right? Now here you can see there is a certain high. It means whoever shot from here to here. Okay, so you can see that the price is moving lower from this $120,000 to almost $17,000. So there must be some shorters down there who actually take shots. And if you guys as a retail trader, you have the idea of that, okay, the most liquidity, the most stop loss for those shorters would be at this high, which is at $120,000, right? So it does happen. And just to confirm more, you can actually check heat maps, right? So second that, just mark this liquidity here. All right, so now here you have the liquidity, here you have the POI. Now once you see the price tapping back into this POI, and now you can just go on M15 to take a trade if you wish, but here I just wanted to teach you about liquidity, so that's all we are going to talk about. So here you have this. Now we understood the market took out certain liquidity, so we enter after taking liquidity and we target liquidity. So we had the liquidity sweep done, we took out a lot of liquidity over here, we have the POI. The next thing we need to know about is where is the next liquidity. So from high, then you just need to see where there is new low, or the low where there can be possible stop loss. So there are two areas where there might be good stop loss, which are basically the lows down here, which is first this one which you see on the screen, and let's give it and the second one, which is really good, is this low right down here. And if you look here, we also have an POI sitting next to it, which is a fair value gap. So now if you took a short trade from here, let's say maybe stop loss is somewhere down here, you can be looking for shorts till this low whenever you get the opportunity. Okay, so now we will see how does it looks like. Okay, so here you can see we took out the first low, right, and then we started chopping a little bit. That's fine, and then it just, you can see it just keep chopping, but later on we hit the final draw on liquidity. Right, now what next? You can just expect the market, once it has further confirmation, because it took out this liquidity, you can be targeting the next draw on liquidity as well. The first nearest liquidity is the highs of the candle which swept it, which it just did, and yeah, that's how it happens. So whenever you look for a trade, always wait for people getting stopped out or there is a liquidity sweep. If you don't do that, you will be the liquidity. And always look for liquidity or good liquidity to target, either you are in a long trade or you are in a short trade. That is the very second most important thing that you need to know about. Okay, next thing is moving stop loss to break even too early. So let's try to understand this by an example of the trade yesterday we took on our Discord, where this was a euro long trade where we had a very good plan. Okay, so in this video you will also understand that when to change stop loss to break even and when not to. Okay, so I have seen people actually changing their stop loss too early in the trade. And for example, here you can see on the screen that we took out the long trade at the market position over here. It moved up almost 1 hour, and then again it came back to our break even. Again it hit to the risk free area, and then again it hit our break even, and then it hit to the target. Okay, so here in this case you will find, and I've seen many traders out there changing this stop loss break even just because the price is trying to trap them just to close break even. But understand one very simple thing: if your high time frame context is clear, you entered after liquidity sweep or something, and your stop loss does come, your whole plan gets invalidated, then in those cases you don't necessarily need to just change your stop loss to break even too early. You can just let the trade play out fully. But when do we need to change stop loss to break even? There are basically two cases. The first case is where there's a certain higher low, which is the basic liquidity has been taken and you are up 1 or 2 hours. So in those cases you can take out some profits and change your stop loss to break even. Okay, second is when you think if the price come back to your entry area, it's not longer valid anymore, your plan is not valid anymore. So that's very rare case, but yeah, if it does happen, that is the time where you need to change the stop loss to break even. Okay, so these are the two things which are very important to change stop loss, unless you don't really need to change stop loss, because that shows you're not confident in your plan. So you're not trading the candles on M5 there, you're trading your H1 narrative H1 confirmation, right? Or POI. So wait for the trade to play out, give it some room, and then use its side to trade. And if you don't have a journal, make sure you journal it, and you will get to know that most of your break-even trades are actually either you're wrong on your plan or you are just right and you just close at break-even. That is something that happened in most of the cases. So you just really need to work on it. Okay, don't change the stop loss too early unless there is a high or low has been taken, or you just think the price it should not just come back to my entry and it does invalidate you. Yeah, so that's two things is there, and it's very very important. The next thing is trading in low probability conditions. Let's try to understand this by a chart example right down here, which you can see on the screen. So often you will find that the market is where sometimes they are in a range, they often don't offer fair value. An example here which you can see on the screen is that, let's say the market or the Bitcoin is in a range right down here, and you can see in this range there is no fair value gaps. Okay, so here you can see there is no fair value gap forming, which shows it is a low probability condition. In conditions like this, you cannot just take any expansion setups. Even if you are able to take setups, you cannot find more than one or two good setups, right, until you are scalping on M1 time frame. That is a different case, right? So here if you look at this time frame perspective right down here, we can see the market is ranging right now. There's no trade to offer. The market is not offering us any fair value. So conditions like this, you should definitely avoid trading on those conditions. Another example you can see is on XAU chart right here. For example, if you see here, if you look at this whole move right down here, it's completely choppy. Okay, and here it's not just formation of fair value gap, you can also see the market is not respecting fair value gaps. You can see the fair value gap form, it didn't respect it, it just ran through back lower, and again it created another fair value gap. The market did small respect, but of course it didn't did its job, and you can again see there is another fair value gap forming, and the market is totally not respecting it. So in those conditions, all you can do is wait for the market to either take out this range high or range low, and then you again wait for it, and then you simply trade it. So whenever you see sideways market where there is no respect of fair value gap, that is a low probability condition. If you think you're so advanced trader and you may make money in that, completely agree, you are the best trader in this world, and that is why you're still watching this video. Well, jokes apart, it's if you want to take trades which don't give you stress and are more logical, you cannot just trade in conditions like this. Okay, you either have to change or you are just made for it, that's different. But being real, telling you from my own experience, trading in this condition are not the best conditions ever. Okay, and as a trader you don't need to make 100% a month or something like that. 4 5 6 7 setup, without whatever amount of setups you get, if they are A plus, you're good to go and you're stress-free, consistent trader if you do that. Rest, it's your personal choice. Now here you can see again, once we took out the range low after taking a certain liquidity, we started respecting fair value gaps. Okay, and so that is where you can again start looking for trades and all. So yeah, and then you look for the higher time frame and start planning. So but understand this, then whenever there is a condition where there is fair value gap not forming or not getting respected, just stay out of the market and let the range do its job. Okay, because I have seen many people getting stopped out in past 3-4 days trading Bitcoin, and I didn't took a single position in that, and no on gold. I took only trade on euro and one on Ethereum, and I just hit TP on all the trades. So yeah, that's what we do, and that is something really really important to understand. Okay, at last, the only thing I would say is that you are not paid to be active and take more trades. You are paid to be precise. Walk away when it's not your time and strike hard when it is. Patience isn't passive, and it's the most valuable skill most traders should learn. And if this video helped you slow down and think with more clarity, drop a like, share it with someone who may overtrade, and subscribe for more real talk and real setups. Okay? Thank you so much till the time. It's your host signing off. See you. Goodbye.